Hey everybody, welcome back to Drawbridge Finance. My name's Levi Woods, and today I'm actually not even at home. It is Thursday, May 24th, and I'm on the road. We're heading out of town for the weekend. We're going to Pender Island for a little vacation, Karina and myself. Of course, because we're traveling, I wake up to the worst news ever. I have one of my contracts has been assigned. One of my put contracts has been assigned. Now, the worst part is I've actually been trying to roll this contract all week. I've had a position on, and I've been trying to figure out how to take a little bit of money out of the position. I originally put on this trade back in October. On October 5th, Celgene was at $140.04, and I put on what I consider a strangle. So for November expiration, 1 month out, I sold a call position at $150 and I sold a put position at $130, and the stock was at $140, so right in the middle. What I wanted to happen was for the stock to stay in between $150 and $130. That is not what happened. It went down, and it went down a lot. It went down to $120, then it went down to $96, went back up a little bit. Long story short, this stock has been going down quite a bit. And this morning I wake up and I have actually been assigned on my put. So when the stock drops below the put price, it becomes in the money and it can be assigned at any time, which means I have to purchase the shares at the price that I've agreed to. I have actually rolled this down from 130 down to 125 in the last couple of months. As I've been rolling out in time, I've been rolling it down slightly. So I was basically forced to purchase one contract, which is 100 shares at $125 each. The crappy thing about this, that with my brokerage, it actually cost me $40 to make that trade, to have that assignment go through. So I have to buy the shares, 125 times 100, which is $12,500, plus this $40 fee. So the total transaction out of my account this morning is $12,540 negative, and I have now 100 shares. So if I look at the current price of the shares, they're trading at $79.35 right now. So if I sold them, I would be looking at a loss of around, I've got $12,540 minus, I would get $79.35 out of it. I'd be looking at a $4,600 loss. So I have to choose, do I hold on to the shares and wait for them to go back up, or do I sell them for the $79 times 100 and then sell an additional put out in the future? So I wanted to just take a look at what my options are. Originally, the put option that was actually assigned to me was the 125 on June 15th. And I want to take a look at July. If we look at the 125, come on in, love. Hey everybody, say hi to Green. She just got back with tea. It's my partner Green. Anyways, let's get back to this. I need to recoup about $4,600 worth of cash. So if we look at July, I can sell the put again at 125 for somewhere in between $43.90 and $47.30. There's only one contract open. That is not enough liquidity. So let's look at August. They're probably not even available. Yeah, they're not available at all. So my best bet is going to be to go out to the quarter. So if I look at this 125, I'm going to be losing a little bit of money on this transaction. If I can sell at $45.50, maybe I can put this in at $45.70. Then I'm going to be down around $35 on this position right now. And then my hope is that this value is going to start to regain some ground. And I definitely think that's going to happen. I believe that the stock is undervalued right now, and we're going to see an increase in value. So I feel comfortable moving my position out in time and selling this position, selling the put again at 125. Knowing that it's at $79 today and it has to go up to 125 for me to regain some of this cash. So that's what I'm going to do. I'm going to put in this trade. That's it for today. We'll see you very soon. Let's get rich together.